So, first question, I had a general question regarding ID generation. When do you find is the hardest conditions to generate good trade IDs?
Applied Materials Cuts Forecast.
So sorry, I just got the applied material. My Bloomberg telling me that the applied material is cutting forecast. So, when do you find is the hardest conditions to generate good trade IDs? I think in the ID generation, what you want to do is you want to be flexible in the several filters that you would like to have. So if I take, for example, the last few weeks, it's a one-way traffic, but in terms of ID generation, you're mostly waiting for the earnings season to start. So it's pretty obvious that you're not going to be piling up on different positions, and why is it so? Because the outcome could be pretty much binary. So what you'll be looking in situations like those ones is you'll be generating IDs based on special situations. If you get rights issue, if you get spin-offs, or if you look over the last 10 days, what I've been mostly trading is I've been trading one spin-off in Switzerland. I've been trading some spin-off in the US. And sometimes your pipeline, your watch list is going to be drier than usual. What you don't want to do is just, for the sake of putting position and having exposure doing it. So I have to say that in a market like we have these days, the outcome is very much binary. Everything is going up or everything is going down. We're down 20% plus for the year. But it's the correlation is almost 100%. And if you look at the correlation, the reality is for stocks, we are a second derivative of the bond market. So if bonds are selling slash yields going up, the equity market stocks will be going down. So there is a strong correlation, and that means as long as we don't have much color on the earnings season going forward, and on the CPI coming tomorrow, for example, on the big macro number, it's hard to be taking a lot of position. So it's a very hard tell to say, but reality is you will always be generating IDs. Sometimes you're going to have more than usual, and you should not be panicking when you are not having 20, 30 names on your watch list. I think what is very true is many educators will tell you, oh, you need to be putting position now, I'm doing XYZ, and when you go on Twitter, you'll be like, okay, oh, so actually these guys have been doing something, so I need to do something, which is not true. It's all about the risk reward, and having a risk reward that is going in your favor. Another question coming from Sparks, what got you into trading? What got me into trading? So I was still young. That was almost 25 years ago. I have two sisters, and my sisters are older than me, and one of my sisters was doing some uni in France, and one of the unis she was doing is mostly into finance. So most of our friends were going into finance, being traders, portfolio manager, and so forth. So I started to look at it, and I get interested, and just after going into the business school, and even before, I just wanted to be a trader. I get very excited very quickly, looking at. I always enjoyed the macro, looking at the big picture. So having a good understanding of the big picture was something that always attracts me. But on the equity side, I have absolutely no knowledge. So the funny thing is, literally 25 years ago, you had very little access to information because internet was not there. So you were just going to uni either in France or in the US. In the US, it was even worse. So in the US, I spent the semester there in in Miami University, which is not in Miami, but which is in Ohio, and literally guys there don't know what to do and they have no idea. But the whole concept was you go for education and training going through the big bang. So for 6 to 12 months, you are going from one desk to another. For me, it was more like learning just after uni or slash business school by doing the job, and it's so exciting because the beauty of this job, it's always moving, it's always different. There is always something new to learn. So the learning curve is less, it's endless, which is very compelling and at the same time very frustrating because you are always looking for something, for the new thing, and if when you get this new thing, it's already over. So the market from 6 months ago is different from the market from now, which is going to be different from 3 to 6 months. So trading was mostly looking at people, hearing about trading. You have to keep in mind that in Europe, trading portfolio management is not as big as it is in the US. So especially in France, in a socialist country, you should assume that being a trader was not very fancy, and but this is where I started. Emilian, hi Greg, does beta hedge cancel out market view? So the whole concept of beta hedge, I think I've done one video. If you go into the YouTube video, you will find the beta hedge of canceling the market view. So it's not necessarily canceling the market view. Is obviously trying. Let's say you got 5 positions and you beta hedge versus the S&P. You are assuming that if the market is selling off by 3%, let's say, if you're beta hedge, you're going to be flat on the day. Okay. What happens very often, if you look at beta, is it works very well in the first few days of a sell-off. Okay, in the very first few days of a sell-off, as everything is binary, if you get a beta of 0.9, it will do the beta of 0.9. So let's say again, if you have a 5 to 10 day sell-off, it will work fine. But the thing is, after that, the alpha will start to kick in. Okay, so beta works pretty much well if you get diversified portfolio, meaning 10, 20, 30 positions. But in reality, it doesn't work that much when the market goes into full explosion or in full dislocation. Why is it so? Is if you look at the way you calculate beta, it's obviously the correlation between the stock and the index. Okay. And if you look at correlation, you can either decide, you look at the 5 last years, you look at the last 2 years, and you take you can be taking a daily, you can be taking a weekly, you can be taking a monthly. But the thing is, correlation changes over time. So if you take an example, if I take the example, if you look at the FANG stocks, Facebook, Amazon, Microsoft, all those names, they were trading very well until 12 months ago. Okay, so you had some kind of a beta, which was telling you this is the way to hedge yourself. Then suddenly the correlations change. Okay, and your beta is very different. So what I teach and what I learn from my little experience is the beta you need to be using discretionary. Okay, so if you use the beta from let's say Yahoo Finance, which is the 3 years beta, you're going to have correlation over the last 3 years. But again, look at the market.
Diario Financiero. Tax reform. Deputies begin on Tuesday, October 18th. Discussion in particular.
I'm going to stop a bit. But if you look over the last 2 years, so we had the sell-off for, let's say, a month in March 2020. Then we get the rally from March to October, November 2021. But the markets change in between. And then after we had the sell-off. So if you're using the beta for, let's say, growth stocks from April 2020 to October or November 2021, you're going to have one number. And then suddenly it's going to change. So what's going to happen? You start to see dislocation. You start to see a rotation in the market. And this is the time where you need to be changing your beta. So sometimes when we do the mentoring, one of my mentees will come and say, look, the beta of this stock is, let's say, 1.2. And then you say, oh, 1.2, okay, that seems like a lot. And actually, you will be over-hedging yourself with the S&P if you were doing it versus that stock. And then you look at another stock where, it's going to be looking like zero. It's 0.5 or 0.6 beta, and you say, oh, okay, this stock is barely moving versus the S&P. It's going to be fine. And then you realize that actually this is very misleading. And when this stock starts to move, it moves big. So again, beta is past correlation, depends what kind of time frame you take for the correlation. And I strongly believe that you need to be using discretionary. Otherwise, you're going to get hammered from time to time. Okay. Cocolino, question. What is your trading horizon, and do you keep different types of portfolios? So trading horizon, I started literally doing day trading in 2000. So in 2000, my job was, because we had high volatility, to outperform one index, which was the CAC 40 in France, by, if we were replicating the index up to 80%, the last 20% we were trading those 20%, and that would have been between, let's say, 1 day to 3 days. So I started doing 1 to 3 days. Then I wanted to have a book, so I started to have a book, and mostly this book was long with a bit of short. When I arrived in London in 2004, I started on long-only product, where the idea was to go from literally 1 minute to 2 years. And then I did long short, where I had same 1 to 2 years. Then I went into prop trading, and prop trading, you go from 1 minute to 1 to 2 months, 1 to 3 months. Really, 3 months will be pretty stretched. So it's going to be literally from 1 minute to 2 months. And what I've been doing over the last 15 years is from 1 minute to, let's say, 3 months. Okay, roughly. So that's from my professional book. For my personal book, I'm going to have longer position because I can have higher swings in my portfolio. So when I tell people, 1 minute, they look at me and say, 1 minute, you can't be doing 1 minute. Yes, you can be doing 1 minute. I give you an example. If there's a print in the open, let's say a stock is opening at 96 when the last was 100, you buy at 96 and you sell it, 5 minutes later or 1 minute later at 100. Or if you get a news, you hit the tape, that is, M&A story, whatever, rights issue, or earnings or profit warning, whatever. Literally in 1 minute, you could be making, 5-10%. Okay, so that's really active trading. Then you're going to have your portfolio. What you need to keep in mind is when you are a prop trader, especially in Europe, you're going to have these days limited exposure. Okay, so it's if I give you 100, you're barely going to have 100 by 100. When you're prop trader, it's mostly special situation is active trading. When you are working in a hedge fund, like I used to be 15 years ago, you can have more exposure and longer time frame. But the thing is, depending on your style,
oil prices drop as OPEC cuts forecasts for demand growth.
I'm going to close my Bloomberg. You can't have the same, depending on your time frame, you can't have the same returns. Okay, so if you look at active trading, your returns are going to be, let's say, between 50 bips and 5-10%. If you go for 1 to 3 months, what you're targeting is, between 5 to 15% or plus. And that is all. I've done literally all those time frames. And I got nothing against all of them. What I tell people is, I know what I can do as a professional having my setup. I know potentially what you can do if you get a day-to-day job, and it's much harder to do my job as a prop trader for you to do it. Make sense? Another question from Emilian, then I got Jaime. Can I ask you another question? Of course. What do you think about the online prop trading firms? How realistic are them as a path towards working in the industry? Look, I'm working for a prop shop here in London, as you know, which is a UK subsidiary of a US firm. In Europe, you don't have that many firms, prop trading firms. It feels like very much like as a retail trader, there is always like the selling point of, you put 500, and you're going to be trading for 10,000, then 20, then 50. It feels to me like most of them will be scams. And if there are scams, the odds of making it are close to 1%, 2%, 3%. From my experience is what is key is to build your track record. Okay, so and I had many young people in their 20s who are keen on having access to the industry and telling me, Greg, what do I need? And I said to them, if you use a platform like, let's say, Interactive Broker that I'm using, I said to my mentees to use it as well. And I'm not taking any commission. It's just for the record. Why you want to have those platforms is because they give you some good track record. So the track record is kind of audited. You're going to have everything on it. And I've seen literally at Infinity and some other places, people that came after 18 months, 24 months of trading their own money, and that could be $5,000, $10,000, $20,000. As long as this is liquid, you don't have too much drawdown, and you show your numbers. That people that are in front of you, the job of my boss is to understand, the risk management. So as a prop trader, what you're really good at is risk management. Okay. And what we are asking from prop traders is obviously to have some strategies, but as well, the most important thing is the risk management. So we don't want any fuck ups. And when I say fuck ups is, people come to me and say, oh yeah, Greg, I'm gonna, I heard these indicators, 15, 20, 30% drawdown. It doesn't exist in the world of prop trading. It doesn't exist. So people that are pushing for those things, that are pushing for putting 10% of your asset in one position, they are not traders. They have never been traders. They are sales traders. So they have been doing their whole life selling products and selling to clients, but never been trading. So coming back to your question, Emilian, I don't know that many firms. I think there are more in the US, obviously in New York, even in Florida. I'll be extremely careful if a trading company is asking you to be putting, X kind of money, paying X amount of money every month. I'm not sure this is the way going forward. I hear your frustration because very often when we start, we want to have access to capital. We want to prove ourselves. If you manage to have a good track record with not crazy drawdown, with not many concentration, I know that some people will be attracted by that. Yeah. I said next is Jaime. What size portfolio do you need to achieve full independence? Basically doing this for a living, how do you calculate what you need to generate for cost of living maintenance while continuing to grow your portfolio? So yes, I mean, we had the conversation where we started when you did the mentoring, and this is a tough question because obviously you might have different needs. If I take the example, I got 3 kids in London, and I can tell you I can't be living on $20,000 per year. And I guess it's the same with you, living where you are in the US and having kids. So I think what happens is for prop trading, for trading your own money, you need to put the assumptions that there's not going to be, like cash
Applied Materials cuts forecast, blaming export carbs to China.
Sorry, I need to definitely close this Bloomberg. There's not going to be cash flow or money coming every month. So you're going to have some good months, you're going to have some bad month. Bad month when you're trading your own money, you want to limit them as much as possible. So if you think about you, Jaime, example in the US, you're gonna have limited access to leverage, because in the US you only can be using 2 times leverage. I'm talking stocks, CFDs. So that means you might be doing options. And what is as well the cost of your infrastructure? So the cost of your infrastructure could be limited. Literally, if you get live prices, if you get let's say something like a active broker, like interactive broker, like Reuters, it's going to cost you, $2, $3, $4, $500, no more than that. Then the capital you'll be using, I never wanted to go into the direction of pretending that you can be making 60, 80, 100, 200, 300%. And I know, again, that some educators, I think this week, will come to you and saying, oh, this guy has been making 100% over the last 6 months. I've been on the other side. I've seen the numbers. I know the numbers for companies like this, and I can tell you this is absolute bullshit. But the thing is, if you got 1,000 traders, you can pretend that on any cycle, every 3 months, you're gonna have 2 or 3, 5 guys that are gonna be making 50, 100% return, because this is a numbers game. So my job is to tell you that I can't be selling lies. I know that this job is hard. I know as well that when you get a small book, when you don't have the constraint of liquidity, when you can go into a special situation, those kind of things, you can have higher returns than if you are moving, a portfolio that is making hundreds of millions or billions. Okay, so that you can do. So in that sense, you can be more of a sniper if you need to, but the risk management is essential. So what kind of returns? I think, if you can consistently be making without leverage, 10, 20%, and then, with leverage be making more, that will be fantastic. But, I hate all those people that are telling you, especially in the US, to attract you. You trade options, you make 50, 100, 200, 300%. Because unfortunately, people are going for it, and they are all going to get hammered, and the outcome is going to be the same. So put your numbers on an Excel spreadsheet, which is, this is my capital. Okay, so let's say my capital is $100,000. I can be using, in Europe, four times leverage, which gives me access to $400,000 gross exposure. If I take this $400,000 gross exposure, that gives me 200,000 long, 200,000 short. If I take 10% max for each position, that gives me 20 by 20. Okay, and then you say, how many trades can I be making every year? Okay, imagine that you, Jaime, if you were, when we were doing the mentoring, if we could have been putting, one position per week, that would have been a good start. But if you're an active trader, you can assume that, it's going to be 3 to 5 trades at least per week, or more than that. Okay, so if you do 5 trades per week times 50, 250, and let's say you're going to have 30% losers, 30%, one third flat, one third winners, one third losers, and you want the losers to be, half the size of the winners overall, and the flat to be small down because it's a bit of cost, then you look at the numbers, and it's pretty easy. Mentoring, I always do the same thing, which is this one third. How many trades can we be making? What would be average size? And what kind of returns could we have? And you could do the same in the US. Instead of having 4 times leverage, you use 2. And you end up with the numbers. And this is very factual. Okay, it's still, unknown, because you can't be saying, oh, I'm going to be making on average those kind of returns. But that gives you, it's like a business model. When you start a business, you go with the most pessimistic business model. Okay, what are the highest costs? What is the everything? And you see if the numbers make sense. And then you need to take into account that once you start to grow capital, obviously you get a bigger pot, and you can be playing with more money. This is what generally you should be doing. So on an Excel spreadsheet, I don't have a number, but that's what I do, and That's what everyone in a trading room is doing. The boss of a trading room is having, let's say 100 million, 500 million capital. Is saying, I'm going to be splitting the capital between those 20 traders. Those 20 traders must be doing, this kind of return on equity, and we see if everyone is happy with it. Yeah. I carry on. Yes, Coccolino, it's pretty hard to have a 1 minute time frame style if you have a full-time job. I strongly do not recommend. And actually, when I'm doing what I do, for instance, mentoring, I don't do mentoring session when I trade in Europe, for instance. So I will be doing a mentoring session after Europe, or I will be doing it over the weekend, because I realized in the past when I was doing the mentoring, so for instance, I did the mentoring with Jaime. And if I was doing the mentoring, which I never did, with Jaime, and suddenly there was a news hitting the tape, and I would have traded and then talking to Jaime, I know that I would have been losing money. So you can't be doing those kind of active trading. And I know that for many of you, active trading, and when I say active trading, is literally from 1 minute to 3 months, is very attractive, because it's what all about the trading. It's the image that we have when we start trading is those guys, putting position and being in the moment, and that is very true. But I'm not gonna preach people to do it if they have a job, if they have a family, if they have 15 minutes delay on prices. Next question. Questions related to Emilian's regarding mentoring. What approximate percent of mentees end up profitable at the end of mentoring and beyond? And if you know, by how much roughly? So what is interesting with the returns from mentees is, I think on average, people are very secretive about their returns. That's a very weird thing when you do the mentoring. Is there are two things: is people don't want to tell you much about their returns. So my job is to ask them, after session 3, okay, you send me your portfolio, you tell me your position. But as people are very secretive, you're gonna realize at the end of the mentoring, because the confidence is building between the mentee and I, is sometimes they're going to tell you, oh, by the way, I had this other portfolio where I'm doing different from what I learned from you. And you'll be like, but everything is the same. Okay, so to come back on the returns, what I know for sure is what you learn with me is to limit your downside. Okay, so many guys come to me, they lost a fortune. Okay, so before that, they lost a fortune through education and through trading. Okay, through education, they lost between $5,000 and $50,000, and they lost exactly the same or more through trading. Okay, so my first job is to say, okay, this is risk management. So I want you to limit your downside. Then I'm going to have some guys that are going to be putting the hours as well. They're going to be lucky and everything is going to be doing fine. Okay, so if I give you some good example, if I want to sell the mentoring, I could tell you that I had several mentees that had $100,000, $200,000 plus, and we're making 20 to 50%. Okay, plus returns. What I had as well is people losing 5 to 10%. But I know for a fact that if they lose more than that, they will not tell me. They will not tell me because they know that I will be very pissed. Okay, because really my job is to tell you, if you lose more than 5, 10%, you need to reset. Okay, so what I have from this year is overall the feeling, and I can't give you the numbers, that the overall community of members is doing fine. Okay, fine means they are not down 25, 30%. That some of them are making money. If I tell you that all of them are making money, that will be a lie. Okay, but overall, I think the performance is pretty good, and as I said before, it's very secretive, so it's hard to say how much they are making. I really hope that everyone is making money, which is not the case. I hope that, and I know that some guys are doing very, very well, but we are not talking 200, 300, 400%, because if they do those kind of returns, that means they are taking stupid risk. Okay, so give you some example, over the last 2 to 3 years, I had several guys in their 20s, 30s, managing their own money or family's money. And as I said, with 100, 200 plus, we're making 20, 50% return. And those are big returns. Okay, so I'm not gonna tell people you're gonna be making on year one, on day one, 25% plus 50%. I can't, and I don't want to go into that space, because I know for a fact this is just not true. Cocolino, do you trade via your own personal account, or do you trade via your company to enjoy different tax? Someone's got his mic on, so I think Giorgio. So if you could turn your mic off, that would be nice. Should I do that? Can I do that? Yeah. So I used to do both at the start of this year on my personal and professional. Okay. But now I'm only doing professional. Why I'm always doing professional? Because my upside on the professional is much bigger than my personal. Plus this year I had some personal issues with family, and I realized that it was too much, that I could not concentrate on everything. So literally, to be perfectly honest, and I said it before, is I closed all my position, I think it was on 20th of June, literally when the market went first on the 3650. So I'm small down on my personal portfolio for the year, but I'm not professional, which is much bigger than my personal. I think if you think about professional plus personal, it's a bit too much for me. If I have my Bloomberg where I'm putting the position, I'm trading with the system, which is EMSX, then I need to put another position. Plus I need to do the mentoring, then plus I need to do the community. I'm not a superhero. What I do is if I have I'm not doing active trading with my personal book. So I have longer term positions. So my styles will be different. The downside, if you talk to traders, very often the fuck up is your risk management on your PA is different from your professional. And that means your stop losses on your PA could be much wider than your professional. So that creates a mismatch and a mix up between the two, and you're getting confused. So I'm better off, focusing on the professional. Plus I have a boss as a professional, personal as well with my wife, but I can deal with that. Any other question? Yes, question from Sparks. Question, can you expand on collateral going down the toilet? So any business that you have, not any business, but if you go for a loan, if you want to go for a loan, if you want to borrow money, what you're going to do very often is you're going to loan your money and you're going to put as a collateral an asset. Okay, so that can be a house, that can be an asset, that can be a car, that can be part of your company, that can be whatever. So if you take, for example, Peloton, the bike company, the CEO borrowed money with Goldman Sachs, and the collateral was Peloton shares. Okay, it's fine when Peloton shares are when you borrow money and you say I'm borrowing money with the Peloton shares at, let's say, $35. When it goes to 200, you are well in the money. So that means you are equity positive. Okay, and that's the same if you do if you go and borrow money for buying a house, you put 20%. So if you buy a house for, let's say, $1 million, you put $200,000 cash, and as long as the price is at 1 million, you're fine. If the price of your house goes from 1 million to $800, then you're done $200,000, which is roughly your equity. So this is where you get the margin call. And that's the same with the Peloton CEO. When the shares goes from 200 or 100 to $8 these days, then you get the margin call. So what has been happening is, we know that over the last 13, 15 years, everyone is getting more and more leverage. Not only the governments, the corporates, and the retail, the average guy in the street. So as people are more and more leveraged, you do have like the double killer here, where yields are going higher, so the cost of money is much bigger, and as well, your collateral that you're putting against it, some of them are going down. Okay, we are talking equities, we are talking private equity, we are talking from some part of the world, real estate. So if you look at Sweden, for instance, real estate is down 30, 50%, or even 20, 30%. Your collateral is going down the toilet. So what you start to see in Sweden is you get margin calls on big real estate companies. Okay, but that's going to be exactly the same in Germany very soon. So if you look at a company which is Vonovia, which is listed in the DAX, which is part of the Eurostoxx 50, they have huge debt. That's the same with Unibail, which is trading in Amsterdam and in Australia. They have a lot of debt. When first your business is slowing, meaning you're making less revenues, you're making less EBITDA, you're making less margins, so you're struggling to generate enough cash flow to pay back your debt. But as well, what you have is your collateral, your assets, the chunk of your assets are coming down. So if you take the same example of, if you started the year with 100 and 60% was equity and 40% was debt, you're down 30%. So if you came to your bank 6 months ago and say, look, give me 100 because I got 100 as an asset, now your 100 is worth 70, so you're down 30. And this is the vicious circle. So central banks here need to be extremely careful, because as the assets are coming down, we get overall less and less collateral. Yeah. Cocolino, what is the price of your mentoring? How do you charge mentees? So price of your mentoring, you can send me an email and I can give you a bit more color. What I do is I do 12 sessions. I do 12 sessions over 3 to 5 months. We do those 12 sessions. These days it's on Zoom, works very well. Send me an email. I can give you the details, how it works. It's very efficient, and there is session after session you will have different steps to build your portfolio. So I'm happy to talk to you on that. Thomas, when you have generated a trade ID, how important is technical analysis to make sure the timing of the trade is correct? Furthermore, is it important to keep an eye on how many analysts have it as a strong buy, sell when you have an idea on your watch list? So on the technical analysis, retail traders start with technical analysis. Okay, so they go the other way around, and their whole life they are like, okay, technical analysis is telling me something, and I want to believe that it's only about technical analysis. And I said it over and over. In 20 plus years of career, I saw only 2 guys only trading on technical analysis. Okay, one was equity, and actually he left because he was not making money in 2009. And I saw another guy who was trading futures and everything on Elliott waves and doing a lot of money, but that was 25 years ago. So when I generate an ID, the ID can be fundamental, can be special situation, can be whatever. What I'm interested in is trying to identify my upside versus my downside. So when I look at technical analysis, I want to identify levels where I'm confident or where I'm not confident. Okay, so you can be using support, you can be using trend, but the most important thing to me for technical analysis to validate this thing is the participation from the market. And when I say participation, is the volume that is done at the different levels. So yes, technical analysis is important, but if you follow what I do, I've never been into those fancy, signals that are pure garbage. And literally, I know that many retail traders are looking for this magic formula. So when I look at technical analysis, I go the whole spectrum. So, and that's the same when I do my presentation and when I do my day-to-day job, which is, I start with the indexes, I start with the commodities, I start with FX, I start with bonds, and I try to look at what is the big picture. And the big picture tells me, 1 day, 1 week, 1 month, 3 months, 1 year, 2 years, 5 years, 10 years. So I got the whole picture. So even if I could be trading from 1 minute to 3 months, I need to keep in mind about, the big cycle. So when I was doing the 4x4 video series, and now, today someone said, thanks to you, Greg, I saved, £25,000 because the 4x4, I understood the big cycle. You need to understand where you are in the cycle. And that's pretty obvious that when you look at technical analysis, you can understand what is a cycle. And I give you an example, which is you look at the SOX, which is the semiconductor index, you will have a good understanding of exactly what is a cycle, which is 5-7 years of it grows, it up and up and up it grows, and then suddenly it stops. So what is interesting is for many companies, if you look at a weekly chart over 20, 30, 40 years and you put a logarithmic chart, actually you could identify the different cycles of this company. So technical analysis is very important in that sense that it gives you the trigger to decide if that's the good time or not. So what you have is you're going to have hopefully a lot of ideas that you'll be generating, but it's not because this is an idea that this is necessarily a trade. Okay, so what is going to be very important is the rule, timing is everything, and unfortunately timing is everything. You can be wrong by a bit, but if you're wrong by too much, it can be a good idea, but it can be an awful trade. Okay, so yes, technical analysis, I use it. Do I only do technical analysis? No, I don't. Emilian, does it make sense to continue active trading if you keep losing money and ruining your stats? Do you have bad stats, Emilian? No, I'm sure you get good stats. I have macro-based core portfolio positions performing really well, and I try to improve the returns by doing some active trading. Okay, so you're shit with active trading, okay, but you're good with your core position. So I think for me, Emilian, is what is key is to learn and to trade where you're good at. Okay, so what you want to work on is obviously, if I take a big positive, is you say I have good macro-based core portfolio positions. If that's the reality, core macro-based portfolio position, you can be going for size. Okay, so actually you could have a huge size. So you could be this Druckenmiller of this world and putting 1, 2, 5, 10 billion position. When you do active trading, the positions are going to be much smaller because the liquidity is most of the time, especially for stocks, going to be different. So, if you're shit at something, yes, you're better off, improving yourself. But maybe that tells you something that maybe you're just not good at it. That doesn't mean that you're shit overall at trading. It's just that your weakness is active trading. It's not for everyone, okay? And it's not because, there is this dream for everyone that, we should all be traders and driving Ferraris and being in New York. That is a whole fallacy. So active trading requires different setups. That doesn't mean you can't do it. I think, and I hope the community in that sense helps you. When I gave you the chart today of PepsiCo, that is the idea. If you do more active trading, you look at an hourly chart, you look at, where's the volume profile. Those are the things that you'll be looking. Look, I'm sure I think you're still very young, so there is still a long learning curve, but you're doing well. As long as you don't do fuck ups, I'm swearing a lot today, but if you don't do too much fuck ups on the way down, you need to have risk management on the active trading, and you will be fine at one stage. You have a lot of traders that who struggle first. I was lucky. The first 2 to 3 years I was extremely lucky because there was volatility. I have no idea what I was doing, so that was probably why I was making money. But that doesn't mean that you can't do it. And I think more importantly is you need to have strategies. You need to know what you're doing. If you just trying to figure out where is the wind coming from, then you stand absolutely no chance. Question from Sparks: do hedge funds have a head of technical analysis person? No, they don't. Not where I was working. They're gonna have, hedge funds, prop trading, all those things. They're gonna have, their several PMs, different strategies. Technical analyst is part of the game, but literally it's very small versus when you start trading, especially when you're a retail trader. It's technical analysis is 99% of your process. When you're trading, it's much smaller is an understatement, but you can see on the community how much work it requires to generate ID, and technical analysis will be part of it and will be 10-20% of the end of the process, but really not 99% of the process. Okay. Anything else? What do we have? Yeah, I know that so many educators would like you to believe that this is technical analysis, and the reality is all retail traders will fail, will go with it. Okay, they will go for RSI, they will go for MACD, 10, 20, whatever, and they will be paying 3,000, 5,000, 10,000, or they will be buying signals, monthly signal. Then they realize, oh shit, it just doesn't work, and then it's too late. You lost your 5,000 in so-called education, your 5,000 in trading. But this is where, if you tell people I do have like the magic formula, each time the RSI is below 25, you buy the stock, that will be so easy. And I remember when I started to work in the early 2000s, I looked at the signals and I said, okay, below 25 for the RSI, maybe I should be buying, and above the 75, I should be selling. And then you realize that RSI could go from 25 to 15, then to 10, and in between the stock is down another 30%, and you fucked. So it's again, my view is for technical analysis, the best thing that works is to combine the price action with the volume. If you can understand the two together, you will start to be making money. Okay, that is literally something that I don't know how. I naturally started 20 years ago looking at the volume, the VWAP, those things. And then, I started to read more and more. But the rest is a fallacy, is bullshit, total bullshit. Any other question? Or we go to bed because tomorrow we get the CPI, which is gonna be sport tomorrow. CPI 130. Coccolino. I like this name, Coccolino. What do you look at in the fundamental analysis? Quarterly revenue, earnings trends. You should definitely be doing either the 4x4 video series or the mentoring. Fundamental analysis. Literally, fundamental analysis is about roughly two things. Okay, and when I say two things, is the first shortcut. Okay, you're gonna be looking at what happened before. Okay, until now, Those are your numbers, your sales, your earnings, your free cash flow, your different margins, and what is expected by the market in the future. Okay, and obviously you want to know how the company is making money. This company is making money through their business, but as well, what is the capital structure? So is it using debt? Is it using equity? So the numbers is, for me, is when we do the mentoring, we're going to be using, let's say, 2019, 2020, 2021, 2022. We're going to be looking at the revenues. We're going to be looking at the margins. We're going to be looking at the EPS, and we're going to be looking at the free cash flow. And we're going to be looking at how the companies has been doing over 2020, 2021, from 2019 to 2022, and then what are the expectations. And you start to see what this company, how much they are doing, and you always want to compare this company versus the world, which is, your world GDP, your country GDP, how the company is doing versus the sector, and versus how the company is doing versus the industry. And you start to get a better grip of, what are the winners, what are the losers. Okay, and sometimes you start to see that this company actually is not doing as much as, or as good as it used to be. I can give you an example. Intel was doing well until it didn't. Okay, so it did well for 10 years, then last 3, 4, 5 years, they didn't do well because, new competition, AMD, NVIDIA, blah, blah, blah. And this is the way to generate ID. This is the way you compare, versus the sector, versus the industry, how this company has been doing versus expectations. It's mostly when we do the mentoring, we do it over and over and over and over. When we do the 4x4, we do it over and over. I want to believe that I explain it in a nice way, easy to understand. And the thing is, obviously, it will depend. It will change from one sector to another and from one industry to another. Okay. Question from Sparks. Before you go, expectations for CPI. My expectation for the CPI is it's going to be roughly, or it's going to be at 1:30 p.m. UK. So those are my expectations. And then for the rest, you decide. I don't go for binary, but it's going to be at 1:30 p.m. Look at how the market has been behaving. So if last time it was above, we lost 4%. We are at 3,600 for like 5, 7, 8 sessions now. You can see that the market is closing, opening at the same level. In between, we have been shopping around. That's going to be, tomorrow is going to be obviously a big day. We all know that. As I told you, PPI was a bit, we don't give a shit about PPI. It's all about CPI. So 1:30, this is my expectation. The rest, I can't tell you, can't tell you much. So, okay, well, thank you very much for those of you who participated today. Cocolino, if you got question about the mentoring, send me an email and I'll be very happy to come back to you. If you want to discuss with some mentees that have done it in the past, I'm pretty sure that some of them will be happy to answer some of your questions. But let's try to do more of those, especially maybe something that could be more markets related and being more active, and I'll be happy to show you, Emilian as well, how to be more active, and to generate ideas. If you get as well idea on how to improve the community, or if you get question during the day, or things that you would like to see more on the Discord community, push for those things. I'm pretty open, and that's a win-win thing. So tomorrow, CPI, we're gonna have the earnings as well that are starting really to kick in from tomorrow. Friday is gonna be a big day for banks. We're gonna have JP Morgan, Citi, and all those names. So rest a bit for tomorrow. And I hope I can help you with that community even more. All the best. Talk to you soon. Good evening and good night. Bye-bye.